Yes, the tax benefits of oil and gas investing are about as good as it gets. But don't use that as an excuse to flush your hard-earned money down the toilet. Let's talk about it. So there are multiple provisions in the Internal Revenue Code that provide tax deductions for oil and gas investing. And the most popular one is known as the Intangible Drilling Cost, or IDC deduction. So the IDC deduction allows you to deduct in the year that the well is drilled up to 70 to 80% of the total cost to drill the well. So you can write off what are known as intangible drilling costs. So those things include labor, services, anything that is non-salvageable and that is necessary to get the well drilled. So let's give an example. Let's say that you invest $100,000 in a drilling venture. In the year that well is drilled, you would be able to deduct 70 to 80% of that $100,000 investment. And this is super attractive to high income earners because it allows you to offset other active income that you might have through this deduction. But you have to remember that the IDC deduction only applies to brand new wells. I'm not a CPA, but here's a word of caution. A tax deduction or write-off is not the same thing as a tax credit. So a tax deduction reduces your taxable income, whereas a tax credit is a dollar for dollar reduction in your tax liability. So using our example above of a $100,000 investment, you would be able to write off about $80,000 in the year the well is drilled. So you would multiply that $80,000 by your tax rate. So let's assume that it's 35%. So that would yield a $28,000 savings when it comes tax time. And this is awesome if the project is successful because it can improve your investor level economics by 25 to 30%. But on the other hand, if you invest in some crazy drilling venture and the operator drills a dry hole, you're still going to take it on the chin and you're going to lose $72,000. So don't get hyped up about the write-off and use it as an excuse to flush your money down the drain. As one of my old mentors used to say, you know what's better than a tax write-off? Making money. So the IDC deduction exists for a reason. Believe it or not, there was a time in this country where the federal government actually wanted to incent people to go out and drill oil and gas wells. And drilling oil and gas wells carries a high degree of risk. And so this is the federal government's way of compensating people to take that risk. So why am I telling you all this? Because tax advantages are great, but they are not the only consideration when you're thinking about investing in the oil and gas space. The first thing that you have to do is evaluate the merits and the risks of the project. So who is the operator? Who are you investing your money with? Do they have a track record of success generally and in the area where they're planning to drill? How compelling is the investment thesis? Is the project supported by well control and seismic data? And finally, what is your risk of total loss? You should check every single one of these boxes before you ever think about a tax deduction. So participating in drilling ventures is not the only way to invest in the oil and gas sector. And there are far less risky ways to do it. So the tax incentives for oil and gas investing are pretty sweet, and the IDC deduction is definitely the sweetest. But remember that there are other opportunities to invest in the sector. And if you want to find out about them, make sure you like this video and subscribe to our channel.